Hey everyone, welcome back to Corporate Decoder, the place where we take those dry, complicated corporate filings and turn them into something you can actually understand. Today, we're diving into the annual report of Ares Real Estate Income Trust, ticker AREIT, and trust me, it's more interesting than it sounds unless you like reading hundreds of pages of legalese. We'll try to keep it short, but knowing how complicated those reports can be, we might need more than 10 minutes, so be ready. This year, Ares is grappling with some big shifts in the real estate market. We're talking inflation, interest rates, and the ever-changing world of how people use office space, plus a few unique things the company is doing. Alright, let's start unpacking this beast. First off, Ares Real Estate Income Trust is a real estate investment trust, or REIT, structured as an UPREIT. Basically, that means they own a bunch of properties, aiming to give investors steady income. They operate in various sectors like residential, industrial, retail, and office. Their main goals are pretty straightforward, like consistent cash payouts, protecting your investment, and growing the share price through smart management. They are managing a portfolio of real estate and other asset-based investments. Their investment strategy is all about diversification and being flexible and dynamic. They're not just sticking to one type of property, and they might even invest outside the US. Real estate debt, properties outside of the US, and infrastructure might take 30% of the assets of the portfolio. That's their bet to find value where others aren't looking and get better returns. Right now, they are looking closely to the residential and industrial sectors. Of course, it's not all sunshine and rainbows. They're facing stiff competition for deals and customers and are subject to risks from world event-driven macroeconomic trends. As for the specific challenges ahead that they are facing, there are risks like tenants being able to pay rent, the value of their properties going down, and rising interest rates making borrowing more expensive. It's a juggling act, balancing risk and opportunity. They are depending on their customers to pay their rents as they are supposed to. If any of them are unable to do so, it might hurt the performance of the portfolio. Now let's talk about those potential minefields, the risk factors. These are the things that could really throw a wrench in the works. One of the biggest is liquidity, or how easily you can get your money out. There's no public market for these shares, so you're pretty much stuck selling them back to the company. But there are limits on redemptions, and the board can change the rules at any time. And that NAV, or net asset value, that determines the share price, it's not an exact science. The problem is that it is really difficult to get the exact price of those illiquid assets, so you might not be getting a correct price. They rely on experts for that, but their estimates may not reflect reality of the market. And because there are a lot of related parties involved with the management of the company, there are a few conflicts of interest. Because the value of the properties and the market fluctuates, the returns will as well. Sometimes those drops can be quite steep. As AREIT said, our NAV per share may suddenly change if the valuations of our properties materially change from prior valuations. It's a NAV roller coaster. Also, in connection with those offerings or new properties, they might pay a portfolio premium, but they might not take it to consideration when calculating the NAV. This might have a negative impact on the performance and your payment. It's also worth pointing out the ownership structure and other risks with their internal team. Their investors may be at a greater risk of loss than the advisor and other members of the management. Adding to the uncertainty those dividend payouts are hoping for, they're not guaranteed. The company is allowed to take it from other sources, including the sale of assets or borrowings, which will reduce the future returns, but there's no limit, they say, on that practice. If events happen and the company doesn't quantify in NAV at the right time, then you may benefit or lose when purchasing or redeeming the stock. In addition to the limitations described above, we may enter into joint ventures with affiliates of the sponsor. In exercising their discretion to allocate co-investment opportunities, Ares, the advisor, and their respective affiliates may consider a wide range of factors, including strategic advantages, resources, tax, and legal characteristics. Our business is dependent on key personnel at Ares. If these people left the advisor, our operations and investments could suffer. There are some other corporate risks as well. Also, cybersecurity. They rely on Ares systems, so if something goes wrong there, it could have a major effect. It's not possible to eliminate the risk, so it's always on our mind. When it comes to real estate properties, we cannot ensure they are not exposed to hazardous or toxic substances that could be costly and reduce profits. There are certain lease agreements that create risk to our business also. To make sure our investments are aligned and not in conflict, Ares adopted an allocation policy for allocating co-investment opportunities. That's how they try to keep everything fair. The company is subject to debt, and if there is an increase to debt levels, such a strategy would limit the amount of cash available to distribute. This could cause a decline in our NAV and negatively impact the value of our stockholders' investment. Finally, there are potential tax-related gotchas. If the company loses its status as a real estate investment trust REIT, your returns could take a hit from higher taxes. It's like a tax dark cloud. Alright, now the fun part, performance. Since REIT is not traded on any exchange, the price moves based on the net asset value, or NAV. This is something that they do themselves and might not be totally exact, but it's their best estimation. In general, the costs associated with those offerings may decrease the amount of cash available for distribution. Dilution can also happen if the offering prices did not capture the actual prices, so they may use the proceeds to have more profitability. To get some historical insight, they raised $10 per share to Class E stockholders. They weren't that successful since they have to pay a lot of costs. Their returns are lower than expected. To the point of distributions, they have paid a lot over the past 3 years, but it wasn't enough. It was funded from offering proceeds, sales from DST, and some borrowings, so they are not completely covering their distributions. Even their board of directors might change how the distribution will work at any time. The way the company measures the use of debt is by dividing their borrowings by the fair value of their real property investments and other related securities investments. Their current target is between 40 to 60%, and currently they are at 41.2%. Alright, here's a quick snapshot of the key numbers from 2024. Rental revenues came in at $370.8 million, a good jump from $322.0 million the year before. While impressive, higher interest expenses from debt, mostly through the DST program loans, kind of ate into the profits, resulting in a net loss attributable to common stockholders of $37.1 million, even after $12.9 million on the sale of properties. As a result of this, for 2024, they finished with a NAV per share of $7.59, which is not very positive when compared to $8.02 per share last year. That's not a good sign. There is a huge drop. The financial conditions might be good right now, but the key point will be if they find ways to cover operations and NAV. To be clear, they are confident with their procedures to avoid issues. Finally, it's audited by KPMG at Denver, Colorado. Their business is dependent on electronic communications human resources system. Also, they rely on certain things from other parties that they do not control. The company relies a lot on the cybersecurity of Ares, as they mentioned, rely. It includes tests for cybersecurity, simulations on phishing, and training as well for cybersecurity awareness. Also, they used to have internal and external reviews. The company didn't have material cybersecurity risk affected. In general, they pay a lot of attention on cybersecurity. The CSO reports the cybersecurity updates to the ERC. So they seem to be focused on being prepared in case of any incident. In general, their business is very connected to Ares systems. So if Ares fails, they will fail too. Lastly, their board of directors is responsible of taking decisions. One good thing to see is that customer diversification is not that high. The total rent is well allocated to different entities, therefore the risk of their customers' business could affect us. So what's the verdict on REIT? It's a mixed bag. On the one hand, REIT is trying to grow. The move towards prioritizing residential and industrial sectors seems smart to capitalize on current market trends. There's a lot of complexity involved, as they mentioned their investment strategies for non-liquid assets are challenging. On the other hand, those high debt levels and reliance on external parties mean they're walking a financial tightrope. The lack of liquidity for investors and not always reflecting the actual prices as well might be a bad scenario for investors. Overall, REIT presents an opportunity, but the risks are real and potential investors need to make sure that they check the numbers to see if it makes sense for them. Thanks for watching. If you found this helpful, don't forget to hit that like button, leave a comment, and subscribe for more in-depth dives into the world of corporate finance.